On the 20th of August at 4:51 in the morning, a trader on Hyperliquid known as Pension USDT.ETH was short 50,000 ETH. 12 seconds later, the position no longer existed. About $24 million gone, which is about half of everything that trader had ever made shorting crypto, liquidated in 4 tranches with the final 1,417 ETH absorbed by the exchange's backstop fund. And they were one of more than 172,000 traders wiped out in the same window. Over $2.7 billion of shorts liquidated inside of 24 hours. More than 90% of everything closed was somebody betting lower, and Ethereum accounted for around $1.13 billion of it. The largest one-sided short liquidation event since November of 2021. Which means the trade that had been consensus for the better part of a year turned around with a vengeance. So today, we're breaking down how Ethereum is turning things around, why the bearish thesis behind all that short positioning was focused on the wrong thing entirely, and what the SEC proposed one day before the market decided to decimate ETH shorts. My name is Lewis, and this is the Coin Bureau. Now, let's start with what actually happened with ETH during that short liquidation cascade between the 19th and the 21st of August. The headline figure was somewhere close to $3 billion of liquidations in a single 24-hour window, with 48-hour cumulative totals running as high as $4 billion. Longs accounted for just $300 or so million of that. And if you got liquidated on a long while prices pumped 20+%, honestly, I'm not sure what to tell you. But anyway, everything else was shorts. And this wasn't a single spike either, because a second 24-hour window into Friday the 21st added another $1.24 billion, of which around $1 billion was once again short positions being forced closed. Now, these epic liquidation events are a core feature of crypto, but there's some important context here. Most notably, in contrast to what you might see or hear elsewhere, this was not the biggest liquidation event in crypto history. The October 2025 crash was far larger in gross dollar terms, at roughly $19.2 billion, but that was a mixed event with longs and shorts both getting torched. What made August different was the concentration. 9 out of every $10 liquidated belonged to somebody positioned against the market. And on that specific measure, you have to go back to November of 2021 to find anything comparable. So then, why did Ethereum shorts bear the brunt of it? Well, the technical answer is positioning plus depth, and both were pointing the same way. Ethereum carried heavily net short open interest relative to Bitcoin heading into the week, with perpetual funding rates sitting near neutral to negative across the major venues for weeks on end. Bitcoin's funding, by contrast, was closer to flat. Meanwhile, Bitcoin had spent 6 weeks between the 8th of July and the 18th of August grinding sideways in a tight range, which is exactly the kind of compression that encourages systematic traders to keep fading the top of it. But the real problem was the supply side of the order book, because ETH held on exchanges fell roughly 15% from early June to mid-August, dropping from around 7.7 million ETH down to about 6.54 million. Less spot ETH sitting on exchanges means less resting supply available to absorb a wave of short covering, and market makers were apparently positioned net short themselves above the $19,050 to $2,000 area. So when the buying arrived, there was nothing but a vacuum up there. A thin book, crowded short positioning, and one direction. There's also a funny bit of behavioral detail buried in the on-chain data here. Wallets holding 1,000 ETH or more had trimmed their holdings by roughly 1.7 million ETH since the 20th of May, and that distribution fostered a consensus among bears that supply overhang would cap any rally. What they missed, though, was that wallets holding between 1 and 10 ETH had grown their share of supply to 4.52% over the same stretch. So the coins were truly just changing hands as opposed to being dumped on the market. And this is where we could go back to our short whale for a second, because that trade tells us a lot about how confident this side of the market had become. That short was built over around 2 months at 3x leverage with an average entry near $1,700 and a notional exposure of around $106 million. The trader had a 23 win streak behind them and roughly $49 million in lifetime profits from shorting, including about $6 million on a 60,000 ETH short in June alone. So this is somebody who had been right repeatedly for a very long time. And just like that, the market humbled them in a big way. Now the thing is, they weren't alone in the graveyard. One wallet had 1,800 Bitcoin of short exposure wiped for somewhere between 96 and 117 million. An account known as Bowen1476 lost about 71.5 million on 500 BTC, and a third handle went down for roughly 61 million. Ouch.
What if you could trade real US stocks like Apple, Nvidia, or Tesla without leaving your crypto account? Well, that's the idea behind our tokens from BitGet. These are tokenized stocks backed one-to-one by real shares, but the key difference is they are actually usable. You can trade them, use them as margin, and even earn dividends instead of just letting them sit in your wallet. So, if you want to check them out for yourself, sign up for BitGet using the link in the description or by scanning this QR code.
But whatever the case, the ETH move was the violent one, running around 20% intraday against Bitcoin's 8%. Now, market mechanics is one thing, but you only get positioning that lopsided when a bearish story has become the default assumption. And to be fair, the story was reasonably convincing. The argument against ETH was largely that layer 2 networks, or L2s, the rollups that sit on top of Ethereum and process transactions more cheaply, have cannibalized mainnet activity. Less activity on the base layer means fewer fees. Fewer fees means less ETH burned. And less ETH burned means Ethereum has no economic engine. That thesis is what the ETH-BTC ratio was pricing when it bottomed in late June, printing its weakest levels in the better part of a year. And again, to be fair, there's some substance here. Base layer fee generation has been running at something in the region of $700,000 a day, with total L1 revenue nearer $330,000. For a settlement network securing hundreds of billions of dollars, there's no sugarcoating it. That is a small number. But this is the part where positioning got wrong. Falling base layer fees weren't the symptoms of Ethereum losing. They were the deliberate output of a roadmap that has been executing for 2 years. It's a bit like a motorway operator who spends a decade widening the road and then scraps most of the tolls. Read the toll receipts on their own, and the business looks like it's dying. Look at the traffic and at what's actually being carried, and you're looking at national infrastructure. EIP 4844 made it cheaper for Ethereum's L2s to post their data back to the main network without clogging up normal transactions. Then, in December 2025, the Fusaka upgrade introduced Pure DAS, allowing Ethereum to handle much more of that L2 data at once. The result is that transaction fees on the major rollups now run consistently below 2 cents, a reduction of more than 90%, with some measures of median L2 fees down over 95% against previous years. And there's more coming, which was arguably very underpriced up until recently at least. Glamsterdam combines 2 major Ethereum upgrades, Gloaz and Amsterdam, and core developers are saying that it's the biggest overhaul of the network since the merge. The goal is to massively increase how much activity Ethereum can handle. It would raise the minimum gas limit per block to 200 million, more than triple today's level, while also changing how transactions are ordered and blocks are built so that more of the core processes happen directly inside Ethereum rather than through outside services. Its first public testnet just so happens to have launched between the 18th and the 20th of August, right as those shorts were getting wiped out. And the full mainnet upgrade is currently targeted for the 4th quarter. So what does all of this technically work actually achieve? Well, this is where things get super bullish for Ethereum. Ethereum now hosts somewhere around $165 billion of circulating stablecoin supply out of a global market of around $320 billion, which is close to or just over half of every dollar-pegged token in existence. Total global stablecoin settlement volume hit a record $1.79 trillion in the month of June, and Ethereum together with its L2 ecosystem took the largest share of that, somewhere north of $560 billion. Tokenized US Treasuries, meanwhile, approached $16 billion by mid-year, led by Circle's USYC at roughly $3 billion and BlackRock's BUIDL at around $2.64 billion. Over 10 million ETH now sits across institutional balance sheets, corporate treasuries, and exchange-traded products, with Bitmine immersion technologies holding around 4.8% of circulating supply. And roughly 34% of all ETH, something like 41.7 million coins, is staked and locked out of circulation entirely. So, to boil it down, shorts were on the wrong side of all of those fundamentals. Which brings us to the 18th of August. One day before the big short squeeze, the SEC proposed a sweeping new crypto rulebook under Chairman Paul Atkins' Project Crypto Initiative. The 402-page proposal would create a framework for how crypto assets are treated under US securities law. The proposal was approved unanimously by Atkins, Hester Pierce, and Mark Uyeda, and officially published on the 21st of August, kicking off a 60-day public comment period that runs until the 20th of October. Now, 3 things in it are particularly important. First, a startup exemption allowing raises of up to $5 million over a 4-year period, with no accredited investor gatekeeping. Second, a tiered fundraising system. Projects could raise up to $20 million over 12 months with simpler financial disclosures, or up to $75 million if they provide audited accounts and regular updates. And third, the biggest change, a safe harbor that could let tokens stop being treated as securities once the team's promised work is finished or abandoned. Now, if you've been in crypto for a while, all of that might be sparking some familiar ideas. That's potentially a legal route for large-scale token launches in the US for the first time since the ICO boom of 2017. And 2017 was absolute chaos, but in a good way if you were happy to speculate on some very speculative altcoins. Projects raised billions selling tokens under extremely loose utility claims. Regulators came after them later, after the fact, and the legal cases made one thing very clear. Launching a token in America was dangerous. So the industry left. Projects raised offshore instead, setting up in places like Switzerland, Singapore, and the Cayman Islands. For the last 2 crypto cycles, the biggest token launches have mostly happened outside the US and away from US investors. These new rules could bring that whole market back onshore, albeit this time with fundraising limits and some disclosure requirements. Galaxy researchers Alex Thorne has gone as far as calling the proposal a potential ICO 2.0, with a wave of existing tokens potentially using the new safe harbor alongside a surge in new token launches. And if everything goes according to plan and a compliant issuance wave actually happens, much of it will happen where the capital, the stablecoins, and the institutional custody already sits. That's right, I'm talking about Ethereum. Simply put, if bullish momentum is truly returning to crypto, both the price action and the fundamentals line up very nicely for ETH. So if you hold ETH, or an Ethereum ETF, or if you're staking, the mechanical chain runs through supply and it runs through the demand vehicle expanding at the same time. Now, I will mention that the spot crypto ETFs bled $5.4 billion in net outflows across the first half of this year, the first negative half year the category has ever had. However, that outflow stretch is the backdrop that let the short consensus build. And as we've seen, that reversed hard. July brought $365 million of net inflows into US spot ETH products, outpacing spot Bitcoin ETFs on a monthly basis for the first time. And August delivered an 8-day inflow streak, the longest since October of 2025. Cumulative ETH ETF assets have climbed towards $14.3 billion, or roughly 4.85% of Ethereum's entire market cap. And what's more, the vehicles are changing shape. BlackRock's staked Ethereum trust, ETHB, has been live since March, staking between 70 and 95% of its holdings and passing 82% of the rewards through to investors. And it has pulled in over $600 million since launch. Fidelity filed a pre-effective amendment on the 11th of August to take ETH to full staking capability. So the supply keeps getting locked into staking contracts and treasury vehicles, while the products buying it keep growing. That is as nice a setup as you're ever going to get in any market. Now, everybody that was positioned against ETH before the big short squeeze was working from accurate data. L1 revenue really did fall, and there's intense competition from other chains. But there comes a time when those concerns were more than priced in, and that's why we saw the market reverse so violently. And from here, provided that we don't get any majorly nasty surprises, everything points to ETH looking good for more. But what do you think? Is ETH so back? Or is this just a dead cat bounce for crypto's #1 smart contract chain? Please get highly opinionated in the comments down below. And if you want to see the full picture on how the SEC is redrawing the rules for this entire asset class, well, then you should check out our breakdown video on that right over here. Thank you all so much for watching, and I'll see you again in the next one. This is Lewis, signing off.